The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A chill over the AI trade. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Raymond.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. A chill indeed, though we are off of session lows on the S&P 500, down by about 0.5%. You can see a lot of this selling pressure is coming through in the NASDAQ 100. A lot of concerns over OpenAI, which isn't a public equity, but we know that it has a lot of tentacles into these public equity markets. You can see that, of course, in the big indexes. Meanwhile, we're keeping an eye on Brent. Of course, we got some drama out of OPEC Plus this morning. Brent above $111 per barrel, higher by about 2.8% right now. A little bit of a sell-off in the bond market, if you want to call it that. The 10-year Treasury yield higher by about 1 basis point right here, trading at 4.35%, Romain.
Yeah, but let's go back to that AI trade, because it had been the pillar of the big rally over the last few weeks, coming into the month of April like a lion. Does it go out like a lamb? A Wall Street Journal story that said OpenAI is failing to meet targets for sales and new users. That's reigniting a lot of worries about whether the AI build-out is actually grounded in reality, or do we start talking again about the potential of a bubble? OpenAI, of course, pushing back against those concerns, saying its consumer and enterprise businesses are, quote, firing on all cylinders. But with market valuations so high, even the tiniest flaw in the AI narrative, that was bound to cause some degree of selling, and that selling has been intense. Oracle and CoreWeave were down pretty hard earlier in the session. ARM and Credo, AMD and NVIDIA, the plunges making their earnings reports from the big hyperscalers like Microsoft and Amazon over the next couple of days that much more of a litmus test of investors' stomach to stay on the AI ride.
There's been a massive rally over the past couple of weeks over really anything that the AI wand touches. And the reports that we're getting this week are going to have to justify a lot of that move. So that is a high bar. And I think that's more of my concern there is more of a short-term trade move. Over the longer term, strategically, I think that as long as this CapEx keeps going and the market keeps rewarding that, it'll be great. My concern is that at some point it's going to decelerate, and I think that could pretty substantially change the AI story.
So another litmus test to keep an eye on is in the debt market, with a data center developer backed by asset manager Tract Capital that was seeking about $4.5 billion in junk debt financing at more than 6% interest for an AI project tied to NVIDIA. That deal, it was expected to close today, Katie. No word yet on how it's going.
We're going to keep an eye out for that. And we'll also see if earnings can sort of change the narrative, shift the narrative, if at all. We're taking a look behind me at the busiest S&P 500 earnings days by market cap. Here's where we are. April 28th, we have $3.5 trillion worth of companies reporting today. Robinhood, Starbucks, some of the names coming after the close. But what we're really excited for is tomorrow and the day that follows that. Wednesday, we have $14.3 trillion worth of companies reporting. That is the busiest day of the earnings season. It's also Fed Day. And then, of course, Thursday promises to be big as well. So we're getting a lot of fundamental news here when it comes to corporate America, Romain. And you think about all of the concerns that are coming through, especially about the AI trade. Again, it's going to be fascinating to see what wins out here.
Absolutely. Well, our next guest says that even though AI and large cap earnings are driving equities, the market has actually become much more sensitive to rates, oil shocks, and the concentration that comes with that outperformance. Sinha Haldea joins us right now, Global Head of Private Capital Advisory over at Raymond James. Great to see you, Sinha.
You too.
There's a laundry list of things this market has to sort of keep an eye on, but it's actually, at least up to this point, has managed to sort of work its way through that, climb the wall of worry, or whatever euphemism you want to use.
Yeah.
Do you think that continues?
Well, I think the risks to the downside are now greater than ever before. As we've mentioned, any type of sensitivity, or it's not enough just to meet expectations. The market needs to see justification of these valuations that have been driven so high now. And any kind of downbeat guidance or guidance that sounds lukewarm is going to cause a sell-off. I don't think the market's worried about EPS and where that's coming in. The question is, what's in the narrative? What's in the tone? Is there softness if you're a consumer business? Is there inflation-related expectations coming through? If you're a hard asset business, these are the considerations. And of course, in tech and AI, is the AI growth story going to justify where you're trading today?
Well, we've seen a little bit of softness, certainly in language, if not necessarily in the forecast with some of the more consumer-facing companies. With regards to tech, though, I mean, there's been this attitude that to a certain extent is sort of shielded off from what's going on in the Middle East and all of the, I guess, more economic potential things that could batter the economy. Is there an argument to be made that as long as that CapEx, that business spending holds up, that investors there don't have a ton to worry about? I'm not saying they don't have anything to worry about, but not a ton.
I think the biggest thing they have to worry about, as we're seeing today, is the growth because of AI CapEx. Is that monetization of the AI investments coming good or not? The market only has so much patience, as we've seen with sell-offs when expectations disappoint. OpenAI, as you said, is not a public company, but it impacts everything. If its growth is slowing on the enterprise side, that impacts the entire tech category. And let's not forget SaaSpocalypse, the assassination of the marks, as we're calling it in the private markets. Pick your moniker, but the point is that is still down 30% from January.
I haven't heard assassination.
I'm calling it that.
Yet. That's pretty good. We'll try to get that going. But let's talk a little bit about how that's impacting the debt markets as well, because you can see it happening in equities. But you think about big tech, a lot of these hyperscalers coming up and tapping the debt markets, and you know the industry overall becoming a bigger part of the primary markets. Do you start to see some of these concerns come through that channel as well?
We are seeing that already. If you think about what's happening in the whole private credit world, a lot of the accidents that have happened, including a pretty public one a couple of weeks ago, are starting with some of the software businesses that were bought at 21, 22 type of peak valuations with a lot of leverage on them. And some of those stories are not going to come good when it comes to the equity story. But first and foremost, the debt will have to take a hit, and that's not a harbinger of good things to come. You've seen a lot of lending in the space to fund this CapEx. The question is the growth and is the revenue curve to come out the other side of that going to be able to support that value of debt or not? And that story, that's a shoe that remains to be dropped. We'll see that continue to play out, but it's first playing out in private credit and SaaS.
And it's interesting, we heard from JP Morgan's Jamie Dimon today, again cautioning about what is going on in private credit and basically talking about how we haven't had a credit recession in so long. Those are direct words from Jamie Dimon. I mean, do you think that we're in that sort of territory where that's a possibility we have to be entertaining and planning for?
I think the issue with private credit is that the market's priced in nearly zero write-off risk. No asset class has nearly zero risk. Now the asset class is pricing in closer to 8 to 10%, some are saying 8 to 12% type of loss ratios. That's a healthier re-rating. It's taking away the dream unicorn scenario of private credit and making it more realistic for investors. The issue with private credit is that some of this paper has been sold to retail investors in these semi-liquid, quarterly liquidity, call them 40 Act interval fund structures, and that's an issue because this paper has been written often to private equity sponsor-backed companies that have 6, 7, 8-year holds. And so that liquidity mismatch is where you've really seen the pressure over the last quarter or so.
But is this also an issue of marketing or rather the lack of education as well? I mean, I know a lot of people have sort of gone back and forth on this. And it's not to point fingers, but the idea that there is holistically a lot more going on underneath the surface as to why we're dealing with these liquidity issues.
Absolutely. And you have to understand that private markets in general have had an inflow in the last 3 years that is seismic from private wealth at large. And in the initial stages of this inflow, it was all into the 10-year, 12-year lock product. And that's the closed-end drawdown product, and that was reasonable. Now in the last 24 months, with this advent of the intervals fund 40 Act structure, that's what's caused perhaps some lack of education of the underlying investor and what they're actually buying. This is long lockup paper. You should not be able to expect to get your money out any quarter you wish, especially if millions of others are placing redemptions at the same time.
With regard to the performance of some of these assets, and I know there's a lot we don't know given that they're basically privately held, is there a sense here that the interest rate environment has contributed maybe to some of the deterioration? And do you see any potential for relief on the interest rate side anytime soon?
I wish is the answer. I think we'll hear tomorrow. I think we all know what the Fed is going to do. It's very likely to be on hold tomorrow. But the question is, how do they lean in their tone? Are they leaning hawkish? Are they leaning dovish? Are they going to talk about where the bar to the rate cuts will be? That the entire private market cycle is waiting for that. While they've lived to learn, they've learned to live with where rates are today. everyone wants rates to come down.
Sunaina, we can keep going with you. I would normally not interrupt you, but apparently the King of England is set to speak, so we're going to have to say goodbye. We'll have you back soon. Sinha Haldea, Global Head of Private Capital Advisory at Raymond James, as we now go down to Washington, to the U.S. Congress, where King Charles III, only the second UK monarch to address a joint session of U.S. Congress, is now at the podium. Let's take a listen. The King's speech there, a story of the United Kingdom and the United States as King Charles III addresses a joint session of the U.S. Congress, weaving together a story in his words that is one of reconciliation, renewal, and remarkable partnership, a wide-ranging speech that talked about Henry Kissinger's vision of a soaring vision of an Atlantic partnership based on the twin pillars of Europe and America, a speech seeking to reestablish and, more importantly, to highlight the decades, centuries of military, economic, and cultural ties between these two nations. That speech does continue. You can type live go on your Bloomberg terminal. As you join us here in Studio 2, Romaine Bostick alongside Katie Greifeld. It's just a little bit after 3:30, Katie, here in New York City, as we count you down to the closing bells, a focus on Washington, but of course also a focus on the markets.
And the sell-off that we're seeing, at least for today, the S&P 500 down by about 0.5% right now. We've had a lot of concern come through, as expressed through the AI trade. You think about that Wall Street Journal report about OpenAI missing some of their internal targets, and that certainly is sending a shudder through the tech sector, which there's a lot of tentacles there that OpenAI has.
Well, it's kind of interesting, when you looked at everything that fell today, it wasn't just the hyperscalers, it was the chip companies, it was power companies, even Caterpillar was dragged down by this. So basically anybody that is affected by AI or doing AI was being dragged down by this. But it's also interesting timing, right? Because we got some big earnings from basically the biggest spenders in this space, the Amazons and Alphabets and Microsofts of the world, all coming down the pike over the next 24 to 48 hours.
Yeah, an opportunity to see if their spending plans have changed, and also to hear from the executives themselves about how they're thinking through this environment. A lot to look forward to. But there is a whole market out there outside of tech, so we want to turn to another earnings story now, and that is Sysco. Keeping an eye on shares, of course, falling today, down by more than 3% as investors really sift through the earnings, because we heard from the food distributor a little bit earlier, meeting EPS estimates just a month after saying it would acquire Jetro Restaurant Depot for $29 billion. I'm pleased to say that we're joined live by Kevin Hourican. He is the chair and CEO of Sysco, joining us now. Kevin, great to have some time with you. So let's dig into these results a little bit, because EPS meeting expectations, then you take a look at quarterly sales falling a little bit short here, and revenue also missed estimates. So a little bit of a mixed bag, and you're seeing that expressed in the share price. Talk to us about what you're seeing when you take a look at the demand coming through national restaurant chains versus more of the local operations, which I know were a little bit of a bright spot here.
Katie, first, good afternoon. Thank you to you and Romaine for having us on the show. We're pleased to be able to talk about our quarterly performance. As you said, it was an earnings meet at 94 cents of adjusted earnings per share. Most notably, volume. That's how we judge our performance in our space, is volume of growth. Our local business, which is smaller restaurants, up 3.3% for the quarter, which was our strongest performance in more than 3 years in our local sector. So really pleased with the progress that we're making, taking share, improving quarter over quarter, improving year over year. And again, those are those small mom and pop restaurants. As you noted, larger chains, national chains, foot traffic to restaurants down over the past year. In the most recent quarter, down year over year. In that particular segment, large national chains was down for us as well. I do just want to point out one other sector of our business, which we call non-commercial. So think hospitals and education facilities, dining establishments in places like office buildings and the like. That business we call non-commercial, up solidly year over year. In our international business, up solidly year over year with double-digit earnings growth year over year. So local strong, international strong, food service management, non-restaurant business strong, with national restaurants unfortunately down year over year.
We'll wrap that into your full year outlook here, because you affirmed your 2026 adjusted EPS guidance, also reaffirming your full year net sales growth outlook. And I mean, a lot of strength when it comes to international, when it comes to local. But I mean, what gives you the confidence that you'll be able to meet those targets specifically with, I believe, 1 quarter left to go.
Yeah, we reiterated today our full year. We have an earnings guidance range of $4.50 to $4.60. But we said on the calls that we will deliver at the high end of that range. The exit velocity for us in the quarter that we just completed gives us the confidence to be able to deliver that full year. So local volume continuing at the performance improvement that we have been delivering as of late. What we said on our call today is that local volume would be up 2.5% from a volume perspective in Q4. On a 2-year stack basis, that's 120 basis points of incremental improvement year over year, showing that progress that we are making as a company. We're taking share from the overall industry. We expect our national business, the one that we were just talking about, that was slightly down year over year, to improve quarter over quarter. We're retaining the customers we have, and we have some new customer wins that we will be onboarding in the quarter. What gives us additional confidence on the full year guide is our operating margins grew year over year in the most recent quarter, and we had really strong, disciplined expense control. We're a supply chain company, so we pick, we pack, we ship, we deliver millions of cases to customers around the world, and our operational productivity was really strong in the most recent quarter, and that will carry into the full year, giving us the confidence to reiterate at the high end of our range for the year.
I am curious too, Kevin, though, when we talk about the M&A, the pending M&A out there, obviously the challenges that still exist in order to close that deal. You're already a behemoth. When we talk about the overlap with Restaurant Depot's customer base, which isn't a lot of overlap to a certain extent, I mean, it is a huge expansion of your business. What gives you the confidence regulators will sign off on it?
Raymond, thank you for the question. Let me just first start with our excitement about this acquisition of Jetro Restaurant Depot. It's a gem of a business. Think Costco for restaurants, a one-stop shop where restaurants can go to get everything that they need for their restaurant at industry-leading pricing, aka low prices, value prices. So let's start there. It is a channel that is distinct and separate from the business that we, Sysco, are in today. If you're a small mom and pop restaurant, a 1 or 2 restaurant location owner, and you're seeking the best prices in the industry, you go to Restaurant Depot and you get everything that you need for your restaurant. And you're doing that work yourself. You own your own van, you're going over to the store, doing the picking, the packing, the shipping, the delivery back to your restaurant, unloading your van. And it is for those reasons, it's a separate channel. We Sysco are for larger restaurants, even mom and pop larger restaurants who seek delivery. They want the touch and feel of white glove service of a dedicated sales rep. And we obviously deliver the product to the restaurant, and we put the product into their freezer, the refrigerator, and their dry zone. So different customer types, different channels. It's for that reason we have confidence that the government will agree with us that they're independent businesses. More importantly, if I could just make one more point, we're better together as a combined company. We can buy food more cost effectively and be efficient in that process and passing on value to our end customers. We can also build a loyalty program that rewards customers as they migrate between these two channels when we have both of them under one roof. And I'll just give one example in that regard. We have customers that are delivery primary customers that get approximately 2 deliveries a week. They'll run out of things in between delivery. Today, we have limited options on how to help that customer. When we have Restaurant Depot as a part of our arsenal in the future, our sales reps will actually be able to do same-day delivery or even click and collect from that local Restaurant Depot store to be able to help meet that customer's need.
And I can certainly see, just in terms of the business structures, obviously the potential benefits here. Investors raise a lot of concerns. I mean, you're basically paying close to 15 times operating income. You're taking on $21 billion in debt here. I mean, what assurances can you give investors that whatever synergies might exist there are going to accrue pretty quickly in terms of paying down that debt and, more importantly, paying down that multiple?
Yes, we understand investors' concerns in regards to the debt. Let's just take a step back and think about the strategic merits of the deal. On the day of the deal closure, 20% more revenue, 45% more EBITDA, 55% more free cash flow. The deal's year one accretive. It's actually day one accretive. It's year one high single digits accretive, year two mid-teens accretive. I think 2 things surprised the investor community on the day of the announcement. Thing one is Restaurant Depot itself being a privately held company, Romaine. People didn't understand its size, its scale, its profitability. And when you do an announcement that people aren't expecting, and it's about an entity that they don't understand, I respect and understand the investor reaction to that news. The more our investors have heard over the past few weeks about the quality of the Restaurant Depot business, the more excited that they are. $16 billion of revenue at a 13% operating margin. That's double Sysco's operating margin. We're putting more hot water into the tub, improving the overall profitability of the margin profile of Sysco. So let's talk about the debt. It is going to move our debt to earnings ratio, leverage ratio to 4.5 turns, which is higher than our targeted ratio. Obviously, we're going to quickly delever. In fact, we've communicated to our investors that across the first 2 years, we will quickly delever down to 3.5 turns with a transition over time to our historical leverage target of 2.75 or lower turns. The cash flow generation from Restaurant Depot is so robust, we will be able to quickly delever. And what we've communicated to investors, Romain, over the past 2 weeks, is we have a solid cushion on our profit margins and operating profit to cover a dark event or a storm that may occur. We've got a cushion from a profitability to cover something like that. We are extremely confident in our ability to delever quickly and with confidence, and that's something that we're committed to do. By example, we paused share buyback for that first 2 years to show investors that we're deeply committed to delevering.
All right, Kevin, really appreciate you explaining all that for us. Have to leave it there. Kevin Hourican there, the chair and CEO of the gigantic food service company Sysco. Meanwhile, we keep an eye on the other big news of the day, and that is the kickoff of the 2-day meeting for the Federal Open Market Committee. Jerome Powell set to take his last meeting at the helm. Our next guest agrees with the projections from Bloomberg Economics that the Fed is going to leave rates unchanged. Former Kansas City Fed President Thomas Hoenig joins us right now, currently a distinguished senior fellow at the Mercatus Center at George Mason University. All right, we basically had a rate cutting cycle that looked like it started. It sort of was interrupted here for the last couple of meetings. No change expected tomorrow. I am curious, though, as to how much of this debate that's going on behind closed doors today and tomorrow is about the situation in the Middle East and the potential inflationary impact.
Well, I think there's a reasonable amount of that. I mean, it's very obvious that they're where they need to be right now. The discussions are, how long will this go on? How should we position ourselves? And one of the discussions behind that, I think, will be this idea that we're on our way to 2%. I think they're going to take that off the table, and kind of when they come out with their statement, I suspect that will be missing. And I think, for good reason. Number one, inflation has risen. Number two, the tariff chaos is still there, and it's affecting prices and how you think about prices. The energy crisis is there. It isn't hitting the United States as much as other nations, but it is still a factor. So I would say that how much they pull back is really the discussion that's going on right now. And I saw and I'll say one last thing, and Chris Waller's last speech, he's on the Open Market Committee. He was in a sense backing away from his earlier concerns being primarily labor and unemployment, and understanding that he now has an inflationary challenge ahead of him. So I think he's on board with that, and I really think they will modify their language a little bit. Yeah, it was kind of interesting to listen to that speech too. He talked about a lot of potential structural changes that maybe the Fed should consider given some of the shift in the economy. And I know that's going to be a big debate, particularly when Kevin Warsh takes over, who's had obviously some grand ideas about what the Fed maybe should be or could be. Do you anticipate that maybe we could see a broader rethink, not so much of the Fed's role, but I guess just how it approaches monetary policy? Yeah, I do. I think Kevin knows he's got his own challenges, but one of his issues will be the balance sheet, how to manage that, because there's a lot of debt coming on board. We have a very uncertain world right now in terms of the future of the balance sheet with the mounting debt. So how should they address? How should they approach their operations of their monetary policy? Can they begin to slow the growth in the balance sheet or even decrease it? I think that will be a topic. He's talked about it a great deal. And I hope they have a good conversation around that. The other part of this is, what is the neutral rate? I mean, right now, the real rates that the FOMC is working with, they have a 3% inflation rate, 3.5%, a 3% inflation rate, a 3.5% Fed funds rate. So they really have very low real rates. And are those the right set given the amount of inflationary push that they have? And even if the war ends and we get our tariffs, how quickly will it come back towards 2%? And are they really in an accommodative stance right now? And should they think more about that? So he'll have a couple things he needs to be talking with the rest of the FOMC about.
Well, I'd love to hear your thoughts on how communication from the Fed in general might change, because, of course, it's up to the Fed chair whether or not they want to have a press conference accompany every single meeting. But certainly that's something that this market has grown accustomed to under Jerome Powell. And I wonder what you think that might look like, that adjustment, should we go back to a situation where you don't necessarily see a press conference every single time the Fed makes a decision?
Yeah, I think Kevin has made it clear that he's not a real fan of the dot plots and the so-called forward guidance. I think part of that falls into the press conference, because how much you say there is kind of sets the stage for the next meeting. So I think he'll have that discussion with the other members of the FOMC. I think there are members on the committee. If I were there, I would be one of them saying, it really shouldn't be every meeting. It brings more attention to the chairman. It puts more pressure on you to put forward forecasts that you really don't have a full grasp on in uncertain times like these. So that will be another conversation he will have. I'm pretty confident. And I think he will modify that. I really do think he may, if the markets will let him. I think he would like to have fewer press conferences. But like you say, we have kind of, I've learned a long time ago, when you set a policy in place, backing away from that policy is very difficult. So the policy in place is every meeting. Whether he can move back from that, I think, will be a challenge for him and the FOMC.
And before we let you go, we don't have too much time. We did get some consumer confidence figures this morning that were a little bit better than expected for April. But we know that in general, consumer sentiment has been pretty depressed. We know that that hasn't necessarily filtered through into some of the hard data when it comes to spending and other measures. And I just wonder, in your view, how long that sort of dynamic can persist.
Well, personally, I think it'll run through a good part of this year. We have a war that's not good for consumer sentiments, but we also have a very stimulated economy. We have the continuation of earlier tax cuts, the addition of new tax cuts. We have asset values increasing, and gives consumers more willingness to spend. We have this enormous, even though there's mixed news here today on AI, there's still enormous investments in AI. That's a lot of stimulus in the economy. And I think that will create demand and keep the economy strong, or at least GDP-wise, very stable until we get through the rest of this year. And then, depending on how the war goes, how other things go after that, how much inflation is released during this period, that'll begin to affect next year. And that, thinking back, that means one of the reasons why a new chairman and the FOMC have to think about how they communicate with the public, how much forward guidance they can afford to give. So I think we have a strong economy going in, and then we'll see whether it can stay strong or weakens towards the end of the year and into next year.
All right, Thomas, always appreciate your insights. Thomas Hoenig, former Kansas City Fed president, now over at the Mercatus Center. As we continue to count you down to those closing bells, we want to bring into the conversation Jurrien, Director of Global Macro over at Fidelity. And Jurrien, I do want to pick up where Thomas Hoenig left off here with that big Fed meeting underway right now, and kind of ask you the loaded question here. Does it matter for markets right now? Is the Fed even important in this current environment?
I echo all the comments that were just made by Mr. Hoenig. Obviously, the market's not expecting any rate cuts. They were at the beginning of the year, but that was before the Iran conflict and creating an even stickier inflation than we already had. We're at 3 5/8. Inflation's at 3. R*, if it's 1, it means the Fed actually is already very neutral, if not slightly accommodative. And then the conversation will really hinge on what is R*. Is it really a half or 1 or 1.5? And you already see that debate being floated by some of the Fed people. But I think the real question is, how will Kevin Warsh shape the Fed once the baton has been passed? And Mr. Hoenig, mentioned the dot plot. Remember, the dot plot and forward guidance were really byproducts, and QE was really a byproduct of the zero lower bound, right? Financial crisis, COVID, when you can't push rates below zero, you trigger the balance sheet, you do forward guidance, you do the dot plot to let everyone know that rates are going to stay low for a long time. You could argue that at 3, 4, 5%, those tools maybe are not needed anymore, and that we start echoing, Alan Greenspan back in the 80s when he said, if you think you understood what I just said, then I haven't expressed myself very well. And so who knows if we end up with a slightly more opaque and less transparent blend of Fed policy going forward.
Well, Jurrien, let's talk about something that certainly does matter to this market, and that is earnings. You think about the 2 days that we have in front of us, some huge tech companies coming to the line here. We know that there's a little bit of a shudder running through the AI trade today. You think about OpenAI and the worries there that it might not have met some of its internal targets. I wonder how you think this develops as we get deeper into this week. Whether or not this momentum that we've seen, this very narrow rally that has been led by a lot of these mega cap tech companies over the past month can continue.
Well, so earnings have, of course, been the star of the show, and they allowed for the market during the Iran conflict to decline only 10% when valuations declined almost 20%. And of course, prices at the intersection of earnings and valuation. So earnings saved us from a much harsher drawdown, at least as we speak today. Whether it continues or not is an open question, but from the data that we look at, earnings are not only holding up, but they're accelerating, and not just in the U.S., but globally. If you look at emerging market earnings, they're booming right now. And so we do think that this will hold. There's obviously going to be hiccups like we just saw with the earnings numbers. And remember back, not to draw a parallel to the late 90s during the internet boom, but there was a lot of volatility, like big poster child companies of the internet era would frequently draw down 20, 30% and then just make new highs again. So when you have a big story like AI that is sometimes hard to quantify, it does take a certain amount of belief that all the money that's being spent will pay off, you're going to get outsized hits like this. But overall, from what we're seeing, the trend is still very strong, and that's allowing the market to grow into its earnings very nicely.
Absolutely, and we're going to get a big test of that tomorrow. Jurrien, have to leave it there. Jurrien Timmer, Director of Global Macro for Fidelity. And just a reminder, Katie, for our viewers, we do tomorrow after the bell, going to get Amazon, we're going to get Meta, we're going to get Alphabet, we're going to get Microsoft. So we're going to hear about all these CapEx numbers and whether they're going to stand by them.
Are you excited?
I am very excited. And we get earnings tonight after the
know.
bell. Not big CapEx spenders, but you get Robinhood. Starbucks could be an interesting read on the consumer.
Yeah, definitely.
Yeah.
Booking, perhaps.
Booking,
it's going to be interesting to finally get into some of the details from some of these companies that we talk about all the time, especially when it comes to those mega cap names. And as you were saying, I mean, that OpenAI report from the Wall Street Journal, timing here definitely matters.
Yeah, absolutely. And of course, we should point out OpenAI did put out a statement saying they're still running on all cylinders. But again, the proof is always in the pudding, and we bring you the pudding every day around this time. A full breakdown of all of today's market action with our global simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massler, Tim Stenovic, they join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. Here on a day where we normally focus on the S&P, Carol, but I'm going to focus in on the NASDAQ 100, the biggest gap down at the open in about 4 weeks. And that was all based on a Wall Street Journal story that said maybe OpenAI ain't selling enough, as some people had thought.
Yeah, and OpenAI said, basically, in a nutshell, these weren't their words, but, don't worry about it. We're doing okay. But I will say you are seeing it play out in some different names, whether it's CoreWeave and a few others. But this has been that big question, right? Before we were so focused on the war, understandably, this concern about the AI spend, the return on investment. We're going to get some big reads on that tomorrow after the closing bell.
Yeah, our reporting indicates that the company's CFO, Sarah Frier, has told leaders internally that she's worried that the firm might not be able to pay for future computing contracts if revenue doesn't grow fast enough. We should note, Carol mentioned CoreWeave and the like. Oracle shares took a hit as well. SoftBank ADRs took a hit today as well. So sort of like anywhere there's exposure to this trade kind of got beat up.
But isn't this the issue, though, guys? I mean, because the whole thing is every time we make these announcements about this investment here and this investment there, it's not actually money spent. It's a commitment to maybe do something in the future.
Yeah, well, I mean, to CoreWeave's point, Tim, you mentioned one of the companies here. They did say that OpenAI is a terrific partner, but not the only one. I thought that was pretty interesting. Terrific, but we have a diverse and expanding set of customers.
All right, we are off the lows of the session, but definitely solidly in the red for all of the major indices here in the United States. I just do want to point out, we don't have it on the screen, but the Philadelphia Semiconductor Index, which had been on a tear, dropping 4% on the day. You see that reflected in the drag in the NASDAQ composite, which is going to finish the day lower by about 0.9%. The S&P lower by about 0.5%. The Dow Jones Industrial Average only down a smidge, about 31 points or less than 0.1%. And the Russell 2000 selling off by about 32 points or 1.2%.
All right, what does it mean for the S&P 500 in terms of the mix, guys? 232 names, Katie, to the upside, 270 lower in the trade, and you had one unchanged.
All right, meanwhile, you take a look at the sector level as well. And it was interesting, even though it was a down day on the S&P 500, you did have more gainers than losers. 6 sectors in the green, 5 in the red. Your big winner today was energy. That sector higher by about 1.7%. Real estate also having a pretty good Tuesday. So too did consumer staples. But then you take a look at the downside. Information technology down 1.3% as a sector. That was your biggest loser when it comes to points and a percentage. Materials, industrials also bringing up the rear.
We are expecting quite a few earnings after the bell, including from Starbucks, Enphase, and a few others. Booking, the travel agency, out with theirs. And they said that in the first quarter, gross bookings came in at about $53.8 billion. That's a little bit light. The Street was looking for 54.2. Overall revenue did rise about 16% in the quarter, in line with estimates. Agency revenue, that was down by about 2.3%. And we talk about the bottom line here. Adjusted EBITDA, a rise of about 19%, a slight beat here, but you did see a little bit of touch of margin pressure there on the bottom line here. So again, a big focus right now on the travel sector, particularly in light of that increase that we've seen in jet fuel prices and inflation.
And you can see the stock getting hammered after hours right now, down about 8%. And this was a company that had sold off into this report. Year to date, shares down about 19% on a total return basis, Tim. So we'll see, of course, if these losses hold, but more bad news for Booking.
Yeah, I'm looking in their outlook and sort of commentary for guidance for the second quarter and for the full year. The company says that they're assuming the direct and indirect impact from the conflict in the Middle East continues through the end of June. Specifically, their outlook accounts for continued fluctuations in travel demand across Middle Eastern inbound, outbound, and intra-region routes, as well as ongoing disruptions to major transit corridors. They're looking for a recovery in bookings by the second half of the year. The company, though, says they're mindful that a sustained disruption could introduce broader inflationary pressures, including fluctuations in jet fuel prices, airline capacity reductions, as well as weigh on traveler sentiment more broadly. And those dynamics can create headwinds. The stock facing headwinds after hours down 8.3%.
All right, guys, I want to go to T-Mobile, bouncing around here in the aftermarket. The company adding 217,000 new monthly accounts. That's a 6% year-over-year increase compared with analyst estimates for about 192,000 or just shy of 193. So that's a big beat. Company no longer reporting changes in wireless customer additions. Instead, it's focusing on tracking relationships that can include multiple customers' phone lines, connected devices, and home internet service. The company, T-Mobile, you can see bouncing around just a little bit lower as we speak, bumping up its full-year guidance for several metrics, including full-year net account additions, and now expects new monthly account additions in the range of 950,000 to 1.05 million. So again, beating Wall Street expectations for the number of new customer accounts it added in the first quarter. New CEO, remember, at this company, looking to put his stamp on the company. Right now, the stock down about 0.4%.
I do want to go back to Booking, and those shares that remain under pressure. And a lot of this, of course, has to do with some of the concerns about travel trends, not only, of course, because of the cost of jet fuel on the planes, but overall the drop in consumer sentiment and whether that weighs on some of the plans there. We should point out Brent crude prices, oil prices overall, at least in the future markets, have been elevated for 7 straight days. It's always a reminder here that despite some of the look through that a lot of investors have had with regards to the situation in the Middle East, that situation, of course, still far from resolved. The Strait of Hormuz still choked.
Yeah, Booking, for their point, saying that impacts from the conflict to continue through the end of June there. So interesting to see that sort of timeline on it. I will say, when you take a look at T-Mobile, it's interesting to see this new metric that they're promoting, shifting from reporting changes in wireless customer additions, instead focusing on tracking relationships that can include multiple customers' phone lines, connected devices, and home internet service there. Again, now you can see our T-Mobile shares actually popping into the green, Tim, though it's been a sort of jerky trade.
My first instinct when I hear that, Katie, is that, investors and analysts don't love getting less information. And I wonder how they're going to track that compared to like a Verizon or AT&T, which already reported for the quarter, and how that compares. But the company says it sees fiscal year postpaid net account adds 950,000 to 1.05 million. The estimate was for 973,000. T-Mobile shares bouncing around, but now down about 0.1%.
All right, speaking of stocks being down, let's go to Robinhood, down about 3% here in the aftermarket. Just a few headlines. First quarter net revenue, that's coming in a little light, 1.07 billion. Street estimate was for 1.14 billion. First quarter adjusted EBITDA, that too is coming below the street estimate, coming in at $534 million. Street estimate was for 583.8 million. First quarter transaction-based revenue, obviously closely watched, that too is light, $623 million. Street estimate was for 661.3 million, and the company not providing a 2026 outlook for operating expenses. And you guys can see that stock down about 3.5% here in the aftermarket.
Starbucks shares up about 5% in the after-hours trade, a beat and a raised quarter. We came in today with most investors hoping that Starbucks would actually raise its full-year guidance, and it actually did, boosting its full-year comp sales growth as well as the adjusted EPS outlook, and that's a big part of the reason why you're seeing the move in the shares. As for the quarter that just passed, the fiscal second quarter comp sales, they came in at 6.2% plus. The estimate was for 3.65, so a big beat there. U.S. comp sales 7.1%. The street was looking for 3.7%. But there is still some softness here with this company, and that involves international sales. They missed estimates, up about 2.6%. The street was looking for 3% even, and China comp sales up 0.5%. The street was looking for 3.4. So basically right now, this is a story about the U.S. and North America for the most part, but still some concerns there about what's happening overseas.
Meanwhile, let's also talk about Mondelez, those results crossing the wire as well. When it comes to the look back, first quarter adjusted EPS did beat estimates, coming in at 67 cents. The estimate had been for 61 cents there. And then you take a look at the look ahead, reaffirming some of their guidance here. Mondelez still sees full year adjusted EPS unchanged to growth of about 5%. They also still see full year organic net revenue also unchanged to 2%. The estimate had been for a growth of 0.91% here. So maintaining some of those forecasts. You can see shares rising a little bit after hours, higher by about 1.7% or so.
Shares of Visa also rising just a little bit after hours, up about 1%. Second quarter adjusted earnings per share for Visa coming in above estimates at $3.31. Second quarter net revenue beat there at $11.23 billion. Second quarter adjusted EPS, as I mentioned, beating there. And second quarter total Visa processed transactions coming in just shy of estimates at $66.1 billion. A headline, though, the company saying that consumer spending remained resilient, which I think is an interesting comment, given that they have such a good view of what consumers are doing at any given moment when they swipe their cards. Shares of Visa up right now by just about 0.5 percentage point.
All right, and just real quickly, you've got Robinhood down about 6.5%, Booking down about 6.5%, and then you've also got Caesars, which also came out, and it's a little bit lower in the aftermarket, down about 0.3%. All right, guys, a lot of earnings, and of course tomorrow after the close will be the Big Mag 7 for them actually reporting, so we'll be breaking that down. That is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Katie and Raymond, of course, continuing there on the close on Bloomberg TV. Tim and I right here on Bloomberg Business Week Daily and on radio. We'll see you again, same time, same place tomorrow.
As Carol was saying, a lot of the travel stocks under pressure. We do just want to bring you an update on Seagate. Of course, the computer memory company rallying on the back of its earnings, a potential read here on the AI space. But when we come back, we're going to refocus in on the consumer with a big beat by Starbucks and a lot of questions here about where they go next. That's coming up next here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. A bit of a pullback in U.S. financial markets today. A big part of the reason was that Wall Street Journal story this morning, which seemed to raise some questions here about just, well, what the sales growth really is like at OpenAI. Concerns about that dragged down pretty much the entire AI ecosystem. It brought the S&P 500 down by 0.5%, the NASDAQ down by about 1%, the Philadelphia Semiconductor Index down by about 4%, and that entire value chain, when you talk about the power companies, electrical equipment companies, the data center providers, the neoclouds, all moving lower here on the day, Katie. Interesting setup into tomorrow, where we're going to hear from some of those big hyperscalers.
Yeah, interesting to put it mildly there. I did manage to find some bright spots when it comes to this equity market. I wanted to highlight Centene, one of your biggest percentage gainers in the S&P 500. We know it's been a rocky road for those health insurers, but Centene reporting results, markets clearly cheering here, higher by about 14% on the day. We also heard from Coca-Cola, and it's really interesting. They actually reported some sales growth that was pretty strong. Apparently, mini cans of soda are really popular right now. Shares higher by nearly 4%. Can't say the same thing for Broadcom, though. As Romaine mentioned, a lot of jitters around the AI trade, what's going on with OpenAI, et cetera. And of course, a big slate of earnings coming up. You can see shares finishing the day 4.4% lower. And that is our top story this hour. The biggest week of this earnings season is underway, with UPS, GM, and Coca-Cola in the books. Now, Mag 7 results from Meta, Microsoft, Amazon, Apple, and Alphabet still on the docket for the days ahead. But right now, all eyes on the consumer, with Starbucks just crossing the wire in the past 10 minutes or so. Romaine, you can see shares certainly popping after hours.
Yeah, that turnaround plan by Brian Nichols seems to be taking hold. Comp sales growth in the most recent quarter, 6.2%, well above analyst estimates. Adjusted EPS, 50 cents, well above analyst estimates. Operating margin, 9.4%, well above analyst estimates. And most of those analysts, they were looking for the company to actually boost its full year guidance, and it did. The company now saying it sees comp sales of at least 5% for the full year. Its previous guidance was for at least 3% growth. Abby Roach joining us right now, senior portfolio analyst at Allspring Global Investments. And Abby, let's just first start off with the expectation, particularly with regards to the full year guidance. What do you think is giving the company the confidence here to raise the way that they did?
Yeah, thank you for having me. I think we've seen a solid quarter from them. You know, it's been a solid start to the year. Happy to see the results, particularly the comp results. I will say, you know, mid-single digits was the expectations for comps this quarter. I'd heard the most bullish estimates at 7%. So the company certainly delivered a bit of a unicorn frappuccino. And I think they've had a nice momentum so far in the first half of the year. And that's given them confidence to be able to see some nice comp momentum and see that also this quarter flow through to the operating margin. So I think that gives confidence that they're executing with the plan and seeing that translate from a profitability standpoint as well, and probably gave them the confidence to be able to lift that guidance for the year.
Well, one of the concerns coming into this quarter, into this print, was the issue of operating margins. I think there was a lot of confidence that we knew sales were going up. It does look like margins were pretty healthy in the most recent quarter. Do you expect that those margins to actually expand as the year goes on?
That's what we hope. I mean, and they have talked at length about needing to reaccelerate the growth in the business, but we're happy to see that that has translated from an operating profit standpoint, because for us as longer term investors, what we've really been looking for is them being able to translate some of the top line growth into operating margin improvement. So nice to see, you know, this is a nice quarter from them, and hopefully a nice start of them continuing to work through some of those cost saves that they've talked about, the $2 billion in cost saves through fiscal 2028, and happy to see that translating in terms of margin upside and EPS growth as well.
Well, let's talk a little bit about what's going on overseas, specifically when it comes to China, the results there. China, which is the second largest market for Starbucks, comp sales rose 0.5% in the quarter. That is just shy of expectations. And we know that China has been a bit of a question mark for this company. So what do you make of the strategy to this point, and where do you think it needs to go?
We're definitely a little bit disappointed the results on China, but they have spoken extensively about really being focused on turning the North America business around first. So I think where we've seen them focus the bulk of their efforts is where we've seen really the progress in terms of that comp growth, and now starting to see some of that operating margin upside. So again, a little bit disappointed this quarter, but we'll be curious to hear what the company has to say in terms of any actions that they're going to take, and if they can start to shift a little bit of that focus more towards the international business, given the U.S. business is on more solid footing at this point.
And Abby, I know that you're also looking for details on how the whole Back to Starbucks plan has been progressing. The idea that Starbucks, they want to make it more of a place where you want to spend time, friendlier baristas, et cetera. What would you like to hear from management at this stage, especially as we count down to that call coming up?
I think any additional details that they're able to provide us around transactions, about customers, increasing frequency of visits. They've given us a lot of detail in the past about, reducing wait times towards that 4-minute goal. And so we're hoping for any additional detail about what they've seen, particularly from a transaction standpoint. And especially one of the things, too, around the loyalty program for them that relaunched last month. And loyalty is a really important part of their business for the U.S. About 60% of U.S. company-operated revenues come from the loyalty program. So any color that they can provide on the reaction from customers, getting more customers into the loyalty program, and any sort of knock-on effect that they've seen in terms of incremental visits and incremental frequency will be really important, because it could be a potential tailwind for the U.S. business.
I am curious about store expansion. I mean, it looks like they're kind of holding the line here on some of their previously announced guidance in terms of how many stores that they will add on a net basis here. Do you think that we will see at some point, and I know they've done some contraction, but do you think we will actually return to any sort of level of meaningful growth in the footprint? And I'm talking particularly here in the United States.
I think it kind of depends on sort of how meaningful is defined. But I think when we look at what they've talked about of being able to return to growth, albeit more muted relative to the past, but we think with solid growth and solid comp growth, we think their ability to be able to kind of add in terms of on the margin, in terms of new unit growth, we definitely think that that's something that they should be able to do once the business is, again, on more solid footing after a couple more quarters.
All right, Abby, really great to get some time with you. That is Abby Roach. She is Senior Portfolio Analyst over at Allspring Global Investments, breaking down those Starbucks results with us. Starbucks shares remain higher by about 5% after hours.
Absolutely. Actually, the biggest gainer, though, in the after hours trade right now, that's actually Seagate. We didn't get a chance to get to this earlier, of course, to make obviously the computer memory maker. And of course, we know computer memory makers have been all the rage these days. That company basically beating on all of the key metrics here. Third quarter revenue, $3.1 billion. That's a beat. Adjusted EPS beating at 410. And the guidance also well above estimates. The company says for the fiscal fourth quarter, the current quarter we're in, look for 3.35 to 3.55 billion in revenue. The street on average was looking for 3.2.
Well, just an embarrassment of riches when it comes to the after hours trade post earnings. We're going to take a look at Robinhood shares sinking right now. We'll break down why with Dan Dolev of Mizuho next. This is The Close. Taking a look at shares of Robinhood after earnings, you can see down nearly 7%. Let's get right to it with Dan Dolev. He is Managing Director and Senior Analyst over at Mizuho. So, Dan, I mean, you take a look at these results. We know that when it comes to the first quarter, net revenue missed estimates, but it was a really volatile first quarter when it comes to public equities, when it comes to cryptocurrencies, also a very important part of Robinhood's business. Overall, I mean, how are you judging what we saw for the numbers in the 3 months just passed?
Yeah, I mean, look, it was disappointing to see the stock where it is, and they missed on revenues, they missed on EBITDA, and they didn't provide guidance for OPEX for the year, which is a new thing. Yeah. Every quarter they give you that. But it makes sense, right? We've had crypto hitting like all-time lows in Q1. We've had sort of trading fatigue on the retail day traders. And quite frankly, from all my meetings, there's a lot of people who are basically saying this is exactly what's going to happen. I do think you have to take a longer time horizon when you think about Robinhood. One quarter doesn't make the next 15 years, and they have plans to 10x the business. It's probably a buying opportunity from here on.
Well, let's talk about the long-term story a little bit more, because we know that Robinhood has been pushing hard into prediction markets. They got the nod for the Trump accounts as well, I believe. So, I mean, when you think about that long-term story, what do you have the highest conviction in at this point?
I think this is the Charles Schwab for a young generation. So the highest conviction is basically they're going to basically encircle their customers. They've got like 5 million gold members and 27.4 actually million funded accounts as of the end of Q1. They're going to take those people and they're going to basically cross and upsell them more financial services. That's the real long-term trade here. Volatility intra-quarter, right? It's going to happen. Next quarter we could be sitting here and things are going to be, everything's going to be lovely.
I mean, most of the estimates going forward for growth rate for this company, at least on the revenue side, are pretty substantial. We're talking like, high teens, low 20s percentage gains. You think that's achievable based on what we know publicly right now about what they have in the hopper?
So based on as of today, yes, it really, probably, my guess is like numbers are, probably like very, very ambitious. Okay. But things can change very, very quickly, right? So it's sort of, I don't think there's any surprise. That's why you're actually just seeing the stock trade down 7% and not 17%. Yeah. Because I think a lot of what you're saying now is stuff that was known. Remember, we take like a longer term view on Robinhood, pretty much on all our stocks. Right. We try not to sort of make a call on 1 quarter or 2 quarters, but things can change very, very quickly. The war, everything could flip in a heartbeat.
I am curious about the state of the consumer, and you also cover Visa. So we'll go from kind of a modern era tech financial stock to kind of one of the OGs, and we talk about Visa, the payments that they processed in the most recent quarter, up about 9% here. That looks like that was above estimates. Total payments volume up, cross-border volumes up. Overall, a good quarter. You're seeing the shares being rewarded here in the after-hours trade. Is this a story about the consumer?
It's actually a story about Visa. Well, the consumer, actually, yes, it's a story about the consumer, but we're seeing it everywhere. Like, we're seeing the consumer being much more resilient than people think it is. But I think about Visa specifically, it was hated, right? People think it's over. People think cash to card is over. We're taking the other side of it. And you're seeing they Hulk smashed Q1. They upped the guidance for the year.
You Hulk smashed.
They Hulk smashed it. And they upped the guidance. I wouldn't show it physically, but we're talking about.
Katie will do it later.
They upped the guidance for the year. We're sitting here in April. We have a war that's still unclear whether or not it's going on. We've got international travel, which is being taken a hit because of oil prices. And yet Visa is upping the guidance for the year. That's a pretty big show of strength in my view.
And it's interesting because you take a look at shares of Visa after hours, obviously higher by about 4.4%. But then you take a look at MasterCard as well, higher by about 2% after hours. I mean, that story that we're seeing from Visa, obviously we've seen a lot of these card companies already report. But I mean, is this an industry-wide story?
You will see a sympathy trade. I think the reason it's not trading up as much, there's probably a little bit, and we love MasterCard as well, but I think there's a little bit of a worry that they're more exposed internationally. So if there's some weakness internationally, call it like Dubai, call it Emirates travel, MasterCard might see a little bit of a bigger hit there. But overall, you're seeing, I think this is a sign that things are just fine. Didn't mean to rhyme that one, but this is a sign that things are fine. And that everything, all the FUD that was spread around the macro and private credit, it was basically just FUD.
All right, Dan, always great to have you, particularly giving us your snap analysis here on the back of those earnings out of Visa and Robinhood. Dan Dolev, Managing Director and Senior Analyst over at Mizuho. Those are the earnings across the wire after the tape here on this Tuesday afternoon, but tomorrow, it's a big one. We're going to get Qualcomm, we're going to get Alphabet, we're going to get Microsoft, we're going to get Meta, and quite a few others that I'm probably forgetting. We're going to break that all down for you with John Belton over at Gabelli when we come back after the break, right here on Bloomberg.
We're counting down to one of the biggest earnings day on Wall Street, actually the biggest earnings day, because all in, the companies reporting tomorrow represent more than $14 trillion in market cap. Now, this includes Mag 7 giants like Microsoft, like Meta, Amazon, and Alphabet. So let's discuss now with John Belton. He is portfolio manager and managing director for growth funds at Gabelli Funds. John, great to have you with us. We'll get into specifics, but just overall, when you think about the Mag 7 finally towing the line this earnings season, we know that it has been a very choppy start to the year. We saw big tech reassert itself in April, but certainly some existential concerns being priced back in today. All in all, what are you expecting from this cohort?
Well, thanks, Katie. I think I'm expecting very strong earnings. I'm expecting particularly strong fundamentals for these cloud computing businesses. I think it's become very clear that these businesses are accelerating with a bunch of different and broadening revenue drivers on the AI side, things like custom chip programs from Amazon and Google, things like model orchestration services, and just broad-based strength in demand for AI services, I think, is going to lift these cloud businesses. So I think that's going to be the highlight of this earnings season.
Mm-hmm. And then you take a look at some of the specifics here. Obviously, a lot of focus on Amazon, on Microsoft, on Meta and Alphabet. I mean, when you take a look at the setup for some of the big ones that are reporting in the days ahead, where do you have the highest conviction right now? Who is positioned the best in this specific environment?
Well, I think all these companies are pretty well positioned, and I guess it kind of depends how you frame the question. I do think expectations ahead of these earnings seasons, of this earnings season for kind of near-term stock performance, expectations have clearly come up. But, you know, I think starting with Google, or Alphabet, I think Alphabet, we're going to see strong search revenue trends. We're hoping to see accelerating search revenue at scale, which is very impressive. I think we could see really explosive Google Cloud revenue growth. Again, talking to a kind of broadening out in revenue streams at the cloud. So I think Alphabet is particularly well positioned, very uniquely positioned as a vertically integrated cloud platform offering its own chips, its own model, and its own tools. So I think that's where I'd start. I think, you know, Amazon is also a company that should see really strong trends at the cloud business. So that's kind of how I'd start the conversation.
So when we talk about, though, John, I mean, you saw kind of the rally that we had over the last few weeks, particularly in the chip makers. And I know some of that was kind of more the rebound after the big sell-off here. There's some concerns about why we saw such a narrow rally. Why aren't we seeing a little bit more, at least in public markets, a little bit more of a broad embrace of the AI trade?
Well, no, I think we have seen the AI enthusiasm spread to different parts of the chip sector specifically. So you had, you know, the GPU makers had a big rally over the last couple of years. That spread to CPUs, that spread to memory, that spread to storage, and now most recently that spread to public cloud. So I do think there's a lot of enthusiasm. And what we've seen in AI broadly this year, so far this has been the year of AI adoption and AI monetization. So you've seen the big foundation model platforms just posting explosive revenue growth. And I think that speaks to the breadth and depth of AI adoption across enterprises in every sector of the economy. Mm-hmm. And so, no, I do think it's the AI trade has broadened out beyond the early winners.
With regards to some of the valuations, and let's just take the hyperscalers since they're reporting tomorrow. I mean, you have some of these names that are basically a record high, particularly Alphabet. Microsoft, obviously, is well below its record high here. Are you comfortable right now? I mean, even given the CapEx, even given the potential ROI, are you comfortable with valuations where they stand?
Yeah, I think it certainly makes it more challenging. You need to see positive earnings revision on earnings for these stocks to keep going up. But I do think in a vacuum, look at a company like Alphabet, which you mentioned, trading definitely closer to the high end of its historical valuation range. But at the same time, revenue growth has really structurally accelerated here, and they're still showing strong margin expansion. So I think in a vacuum for a company that's probably going to do something like mid to high teens revenue growth with margin expansion on top of that, and a really clear and clean AI story trading, call it a mid-20s PE on forward earnings, doesn't strike me as overly stretched. So full yes, but not crazy.
And when it comes specifically to Microsoft, I wonder, how you're thinking through some of the other headlines that we got this week, especially when it comes to exclusivity with OpenAI, how that sort of changes anything, if at all, for Microsoft.
I think the OpenAI situation with Microsoft just shows we're moving to a kind of multi-cloud world. The big cloud platforms are going to be offering orchestration services across every model. For Microsoft tomorrow, I think this is going to be one of the first earnings where the real KPI that investors are going to care about is Copilot. So for so many quarters, investors have only cared about Azure. Obviously, Azure still matters, but we really need to see Copilot, because for Microsoft, it's a stock where the multiple is derated on fears for their software business, and the way to kind of turn that around and to stabilize the multiple and to reinvigorate excitement in that stock is to show re-acceleration in Office 365 and Copilot trends.
I do want to get your thoughts, John, on Amazon. Obviously, a slightly different story, but particularly when it comes to the cloud computing division, we just heard, I think, just a little while ago from Andy Jassy kind of articulating a little bit deeper into where they go. How do you see Amazon fitting into this AI story?
Well, Amazon, I think if you read Andy Jassy's annual shareholder letter earlier this month, I think he probably pre-announced some of the good news for this quarter. But when I think about AWS, they have a unique and I would say building custom silicon effort. Definitely strength with CPUs with their Graviton program, but more recently it seems like Trainium is sort of catching on and gaining some traction. And those are both multi-billion-dollar revenue businesses growing at really fast rates. So that's a unique offering that they have. And then they have this service called Bedrock, which I think is going to capture a lot of the explosive revenue growth we saw from Anthropic in the first quarter. Bedrock is a model orchestration platform. And I think that's become a very important source of revenue acceleration for Amazon as well. So I guess bottom line, I think Amazon has sort of been a sleeper in terms of AI. It was kind of labeled, AWS was labeled as falling behind and losing share in AI. And I think they've sort of turned that story around with some of these more unique offerings.
All right. John, always a pleasure. John Belton, Portfolio Manager and Managing Director for Growth Portfolios over at Gabelli Funds. Katie, giving us a nice look ahead here to what is going to be the most consequential day of the earnings season so far.
$14.3 trillion worth of market cap reporting tomorrow. Really interesting point when it comes to Microsoft, that the metric you want to watch here is what we learn around Copilot. It's not necessarily the cloud, still very important, but that is certainly where investors' eyes will be trained. So what sort of traction that they're seeing there? Yeah,
I'll refrain from making a Copilot joke, but but we do know this is a revenue juggernaut, and it's kind of interesting too because you see a lot of parallels, kind of what they did with Azure. Of course, the idea of like how AWS ended up being this kind of sleeper business for Amazon. They became the dominant business. Can Microsoft now pivot, or not pivot, but expand not only out of Azure over into Copilot? I do want to bring you some breaking news here, Katie Greifeld.
Yes.
This is on alcohol. Yes. You're not drinking a lot of that these days, but of course the saga between Brown-Forman and Pernod Ricard, we're now learning that they have actually terminated their merger talks. You see the shares of Brown-Forman down about 7% here in the after-hours trade. Remember, earlier we had actually heard that the company had actually favored a deal with Pernod Ricard. We don't really have any actual details as to why they're calling off the merger. Of course, the alternative proposal came out of Sazerac, which was looking to buy the company. Yeah, it's interesting. We actually saw a report from Bloomberg Intelligence saying that Pernod needs $600 million worth of cost cuts for a Brown-Forman merger. Maybe that sort of math went into this decision. But as you point out, you can see shares of Brown-Forman absolutely sinking right now, down about 7%, 6% now. But let's take a look at some of the other notable movers in the after-hours trade, because, boy, there's a lot of them. Starbucks out with a pretty good earnings report, being well received right now, higher by about 5.6%. Robinhood, meanwhile, we know that the first quarter was a bit rough for them. The outlook not exactly inspiring either. Shares down about 5.9%. Seagate, as Romain mentioned, surging right now, higher by about 14%, and Booking seeing some disruption from geopolitics, lower by about 5%. This is The Close on Bloomberg. We are keeping an eye on the Federal Reserve, which is expected to hold interest rates steady when it makes its policy announcement tomorrow. It will be Jerome Powell's final meeting in his term as chair. Even with no changes in rates, certain financial companies, particularly regional banks, can actually benefit from other policy tailwinds in the second half of the year. That's according to a recent analysis by Bloomberg Intelligence. Here to talk about this is Kenneth Kelly. He's the chairman and CEO of First Independence Bank. He's also the chair of the American Bankers Association, representing about a $25 trillion industry, also a board member there for the Chicago Fed's regional office. Great to have you here, Ken.
Great to be with you, Romaine. Thanks for having us.
I do want to start off with the Fed. No one's expecting any changes in rates tomorrow. In fact, a lot of folks aren't really expecting any changes in rates at all for the rest of the year, partly because of the situation in the Middle East with regards to inflation. As a community banker and as somebody who represents the entire banking industry under the ABA, has this become a concern for you and for some of your members now that we might not get any real interest rate relief?
Well, I will tell you, stability is very important in the banking system. And what we're seeing right now is the need for people to understand what's going to happen with these costing pressures that are happening from a geopolitical perspective. And so I will tell you, when you think about the homes back in Detroit, where our bank is based, where the average household income is under $50,000, gas prices have an impact on those homes. And so that is certainly something that we are very concerned about at this point in time, the stability. And so, as you've just mentioned, I anticipate rates may remain the same.
Are you concerned about the trajectory of the economy? I mean, not just with regards to inflation, but the labor market as well. I mean, all the things that the Fed has to balance out.
Well, I think the Fed is doing a fine job in trying to manage as best they can, given the uncertainty that we're seeing. Looking at the geopolitical issues and what's happening worldwide is going to have a big impact across the board. The big issues that bankers are thinking about now is being sure that fraud is taken care of. Another issue that we're dealing with is a stablecoin issue there in Washington, D.C., being sure we do not have disintermediation associated with deposits, so we can't lend in those local communities. But those are things that are top of mind.
But that's kind of at odds with what the White House is saying. I mean, the White House says, okay.
It is. Yeah. It is. Certainly so.
Yeah.
I do want to talk a little bit more about, what we're seeing when it comes to the Federal Reserve, because tomorrow it will be Jerome Powell's last time at the podium. We know that we're going to be welcoming in a new Fed chair, or looks all but likely in Kevin Warsh come May or so. And, as a board member of the Chicago Fed, I wonder, how you're thinking about the fact of what a Warsh-led Fed might look like, what changes could accompany that, not so much when it comes to interest rates, but communication, for example, a lot of talk about the balance sheet lately.
Well, I will tell you, as a representative who sits on the board, I'm sitting in this seat as that, not on behalf of the Fed today. But Kevin definitely has a background. If you look at the training, he served as a governor. He understands the issues. He's managed through a crisis. And so we have to take him at his word. I heard his testimony. I thought he did an excellent job in speaking before the Senate Banking Committee and talking about the things that were important under his leadership. And so we take him at his word on that, and hopeful that the Fed will maintain its independence. I think history has shown an independent Fed matters in an economy, and that's something that we're certainly interested in.
Yeah, absolutely. I mean, you listened to that testimony, as you said. He was very clear about his thoughts on Fed independence as well. But even so, I mean, do you have concerns around that? I hear what you're saying, that you take the man at his word. We heard from him directly, but you think about the potential consequences. Is there any point in time that you could draw to that you might be worried about returning to?
No, I would tell you again, I'm going to take him at his word and what he said and what he testified before the nation. And we will live with that at this point in time. I am hopeful that he will come in with the intent of ensuring that we have an independent Fed, and that independent Fed has been in place now since 1913, and it's been that way for a reason. I think it certainly has survived the challenges of the '29 crash and the Great Recession we just saw. And so we're going to take him at his word on that. I'm grateful to be one of those who serve and provide a little bit of input on that, but certainly we're going to represent banking in general in that regard.
I do want to talk a little bit more about just the structure of our banking industry right now. I mean, you had a minority deposit institution. You've doubled its book value over the last 4 or 5 years, and despite not actually having a background as a banker, which kudos to you.
Thank you.
But I am curious about what the message that sends, because, there was a lot of talk, particularly after the financial crisis, when we started to see the number of banks dwindling, particularly smaller and community banks, and the idea as to whether we needed them, whether we can just live with the big money center banks, the JP Morgan Chases and Bank of Americas of the world. Do we need more community banks? Do we need more of these minority deposit
We need a
institutions?
healthy banking system across the board.
Yeah.
You have to have from the largest with Chase down to the small de novos. And we have a challenge in this country with de novos now, Romaine.
Mm-hmm.
And I would tell you, I think about it very much like the rural community I grew up in, Eufaula, Alabama, 15,000 people.
Yeah.
I got my very first loan from the ability to be able to go and move to another city and take a job as a new engineer. That's because someone in the community knew me and knew my character and was willing to loan me money. And so having that ability to be able to have, I'll call it the capillaries in rural communities, is very important in the banking system. And so when you look at us across the totality, from the largest banks to the mid-size, the regionals, and community banks, they make up what is great about our American banking system.
Obviously, as head of the ABA, you're spending a lot of time in Washington, I would assume. You mentioned the stablecoin issue, which is a little bit at odds with what the White House is saying. From a regulatory standpoint, I mean, if you had something at the top of your wish list that you can snap your fingers and get this administration to do, what would it be? It
would be on fraud. Right now, we're seeing trillions of dollars being impacted in fraud, and typically is hitting the people who are most vulnerable. And so we need an all-hands-on approach on fraud, being sure that social media companies are taking care of their responsibilities and not allowing a blind eye to allow fraud to happen to our seniors and others. And so that's an area, I tell you, that all bankers can agree upon, that we need to mitigate fraud.
All right, Kenneth, always great to have you here. Great insights. Kenneth
Great
Kelly.
to be with you.
He's the CEO of First Independence Bank and the chair of the American Bankers Association. Stick with us. We're going to set you up for what to watch when we come back after the break, including a big IPO for Bill Ackman. That's coming up next here on The Close, right here on Bloomberg.
Well, Bill Ackman's Pershing Square IPO is set to price at any moment and begin trading on the New York Stock Exchange tomorrow. Let's discuss with Bloomberg's Anthony Hughes joining us now. So talk to us, Anthony, about what we're expecting to see in the next few minutes, the next few hours, and how that's going to set us up for tomorrow.
Well, Katie, we'll see in perhaps very soon, or it could be in a few more hours, we'll see Pershing Square confirm that the deal has priced. I mean, the price is not really a secret in the sense that it's going to be $50 a share for the entity, which is called Pershing Square USA, which is essentially it's a closed-end fund. But as Mr. Ackman has pointed out, this is one of a rare opportunity to invest in a listed hedge fund. And that will be a pool of capital that he'll invest over time.
What has your reporting shown with regards to just the demand for this? I mean, we know he tried to pull this off in a slightly different structure before, and there were a lot of things working against him at the time. What's demand looking like?
Yeah, well, this has been a long road for him, and he's tried this before, but this time he's come up with a more, some would say it's a more complicated structure, but in some ways it's not that complicated. It's just that it's a more, it's not necessarily easy for people to understand at the first glance, but essentially what he's done here is he's come up with a structure whereby he's offering a bonus share in his management company, and that's really going to be the incentive for people to come into this deal, and that's why there's a reasonable amount of institutional demand, some of which he tied up early on in this process, $2.8 billion in terms of the capital commitment, which, as Mr. Ackman pointed out in the roadshow, was the largest capital commitment for an IPO ever, according to his bankers.
Okay. All right.
But so overall, he's raising $5 billion, and it looks like a large chunk of that's going to be institutional, but that's including that private placement, that $2.8 billion. So really, what we're going to see, if you do your math here, you can say that he's probably going to get about $750 from retail, which is a big chunk of the IPO being retail, but obviously helped by the retail networks of the brokers who are backing the deal. But also, we're going to see some money coming through some of these self-directed platforms like Charles Schwab, like Robinhood and Charles Schwab, which are also on the cover of the prospectus as helping out with the deal.
All right, Bloomberg's Anthony Hughes, as we await sort of confirmation of that offering of shares of Pershing Square USA. Bloomberg reporting, according to people familiar with the situation, was about 85% covered by institutional investors. And we will hear from the man himself tomorrow, right here on Bloomberg Television, the CEO and founder of Pershing Square, Bill Ackman, at 12 p.m. New York time. Meanwhile, some breaking news, Katie Greifeld, right now on Disney.
Yeah, this coming from Insider. Disney apparently no longer planning to spin off ESPN. Again, that is reporting coming from Insider. You take a look at Disney shares right now, not too much reaction to that report.
Yeah, and I think with Josh D'Amaro coming in, you were kind of expecting whether he would sort of relook here at some of the longer-term strategies, which, of course, had included a potential spinoff of that, apparently keeping that now in the fold. We do want to set you up, though, for what to watch over the next 24 hours, because it is going to be busy, Katie Greifeld. Earnings before the market from Etsy, Avis, and Brinker, but it's the aftermarket earnings that everybody's going to be watching.
Yeah, we know that is just the warm-up for what awaits us after the bell. Meta, Microsoft, Alphabet, Amazon, Qualcomm, Ford, Chipotle. I don't think I forgot anyone, all reporting after market tomorrow. Romaine.
Yeah, and we should point out, too, we're kind of seesawing back and forth, but before market, we do get some economic data, housing starts, durable goods, wholesale inventories, building permits. But I kind of think it's funny. We've kind of downplayed what would normally be the star of the day, and that is Jay Powell and a big Fed decision.
I know, and our special coverage, of course, starts at 1:30 p.m. Eastern right here on Bloomberg. It's going to be interesting, you know, a little bit sad. It's going to be his last time taking the podium as Fed chair.
What do you think that press conference is going to be like? Do you think he's just going to reflect on his years, or is he just going to play it straight like he normally does?
I have to imagine he'll stick to his script and play it pretty straight.
He's going to come out in like a Deadhead T-shirt or something. And
maybe
like,
some of the journalists will try to get him to maybe reflect a little bit and wax nostalgic, but it doesn't seem like his style. I don't know.
All right, well, we'll see if Michael McKee can get him to chuckle and maybe lighten up a little bit on what is supposed to be his last Fed press conference. All right, all your political coverage is coming up at the top of the hour. The Balance of Power team taking over right here on Bloomberg.